Today, crypto markets plunge amid fallout from FTX's collapse. Changpeng Zhao lays out the lessons learned from the crypto exchange's financial struggles, and Alex McDougall of Stablecorp explains what the Binance FTX deal means for the industry. Welcome to CNBC's Crypto World. I'm Jordan Smith. The FTX crash has wiped billions of dollars from the market. Major digital currencies extended their slide for a second day as the market deals with the fallout from Binance's planned bailout of rival crypto exchange FTX. As of noon Eastern, Bitcoin dropped by more than 6%. Earlier today, Bitcoin hit a new bear market low of around $16,900. Ether fell nearly 11% to less than $1,200, and Binance's BNB token was down by more than 20%. Part of today's losses are thanks to a report suggesting that Binance could back out of the deal to buy FTX following an initial review of the company's financials. In a statement to CNBC, a spokesperson for Binance said, quote, "We're just 36 hours into the due diligence process. Once we've completed that, we'll make a decision based on what's in the best interest of Binance's users across the globe. We'll share more information when we have a more substantive update to provide." All right, let's talk about the top stories. First, FTX CEO Sam Bankman-Fried is no longer a billionaire after his estimated personal wealth sank nearly 94% in one day to around $990 million. This comes after Binance CEO Changpeng Zhao announced yesterday that his firm reached an agreement with FTX to take over its non-US unit following mounting concerns over potential insolvency. Those rumors led to a slowdown in withdrawals and a freefall in the price of FTX's token, FTT. Bloomberg reported that while the exact terms of the deal weren't disclosed, it's likely that SBF's $15.6 billion fortune will be wiped out at the hands of his billionaire rival. This is quite the juxtaposition from SBF's image just a few weeks ago, when he was willing to pour his massive fortune into saving the crypto industry, backing failing crypto projects including BlockFi, Voyager Digital, and Celsius. He also donated millions of dollars to Democrats ahead of yesterday's elections. Next, following yesterday's announcement, Zhao tweeted his big takeaways from the turmoil. He revealed the two, quote, big lessons learned. 1, never use a token you created as collateral. And 2, don't borrow if you run a crypto business. He stressed the need to have a large reserve. He then noted that Binance never used its BNB token for collateral and has never taken on debt. Zhao's firm announced it would liquidate its holdings of FTT due to, quote, recent revelations. Those revelations came from CoinDesk, which reported concerns over the balance sheet of FTX's corporate sibling, Alameda Research, being too dependent on illiquid tokens, including FTX's own FTT. Last, the proposed sale of FTX's non-US business to Binance could attract the attention of antitrust regulators. Citing a research report from Bernstein, CoinDesk reported that crypto exchange Binance would have a more than 80% share of the global crypto market if the agreement to buy rival FTX moves forward. The research also reportedly noted that although the FTX and Binance entities holding the non-US businesses are offshore, if FTX has investments in the US or Europe, it could cause regulators there to get involved. Regulators can block major mergers if they think it could limit market choice. According to CoinGecko, Binance is the largest crypto exchange in the world by volume, and as of today, FTX dropped to number 10. All right, on to our main story. Crypto World's Talia Kaplan spoke with Alex McDougall, the CEO of fintech firm Stablecorp, about all the market movement following the agreement and what the deal could mean for crypto investor sentiment.
So yesterday we learned about this mega deal between Binance and FTX. It sent shockwaves throughout the industry. And, the instability at one of crypto's most trusted institutions sent related assets tumbling as investors reacted to contagion risks. FTX's token, FTT, plummeted by about 80% yesterday. Bitcoin, double digits drop. And, Solana continues to slide. What do you make of all of this?
Yeah, and I think a lot of it is the speed with how rapidly this did or didn't happen. And I think kind of the biggest takeaway for something like this, where something so huge with industry players that are so dominant in a space, is this is a really big challenge for kind of the institutionalization of the industry. I mean, when something like this comes about so fast, there's so many rumors, there's so much noise around it, and then it's done, but is it done? There's major fallout in terms of the public markets on what you can see in terms of tokenization and token prices. All of this presents a really challenging pictures for the institutional players that the crypto industry has had challenges this year, but has made really some very good strides. around attracting that institutional capital. And so to have sort of the darling of institutional capital, somebody like FTX that has a really strong institutional cap table, go through something like this that's so public and so messy, it just tells a really, really challenging story. But at the same time, it's a fascinating case study for the transparency of digital assets. I mean, you compare and contrast this to something like the Twitter M&A, and in that, all you really have is public information and noise. And in something like this, you can follow transactions around. You can see FTT tokens being moved. You can see liquidity being moved around. And so it's a really, really interesting case study in how much information is available, how we process this, and ultimately, how we internalize large transactions like this.
Now, you mentioned the biggest takeaways. Binance CEO Jinping Zhao, or CZ, actually tweeted about this, saying that the two biggest lessons learned, in his view, are number one, never use a token you created as collateral. Number two, don't borrow if you run a crypto business. Do you agree that those are also some of the biggest lessons?
There's major lessons across the spectrum from everything that we've kind of learned dating back to May. The two that CZ pointed out there are, I would maybe amend the first one to the liquidity and volume of a token is absolutely paramount when looking at the whether its value as a collateral. And you need to be looking at what the amount of downside is in a terrible illiquid bear market versus what it looks like on a regular normal day for how to actually liquidate collateral. And particularly with FTT, it's a relatively thinly traded token, and a lot of that volume does relate to its issuer. So if there's a takeaway around the issuer having a heavy market in a token that it's also using as collateral, there are fundamental risk management challenges with something like that. So when you are using collateral, liquidity, volumes, market depth, all of those are absolutely critical. And knowing and understanding the contagion and interrelated and correlations around the assets that you're using as collateral is probably one of the biggest takeaways for something like this.
Right now, this deal is all based on a non-binding letter of intent. What happens in the event that this deal actually doesn't go through?
You look at traditional M&A cycles and you look at how long these take to put together, and you look at how long they take to close, and you look at the very well established structure that we've developed over hundreds of years of traditional commerce. And I know we're reinventing a lot of these things in Web3 world and in crypto land, but this is just not how M&A deals are done. And sometimes it's okay to take massive leaps and move things forward, but there's so much complexity in a deal like this. I mean, if you put this on par with some of the biggest traditional M&A transactions, this is one of the biggest and most complicated deals that would ever happen. And it was basically announced in the space of 2 hours on Twitter. I mean, FTX already has a number of half-completed transactions from what they've done over the summer. What happens with those? How the antitrust considerations that are inherent in a jurisdictionless body like Binance. There's so many questions around that are even bigger than this non-binding LOI. So any kind of market reaction to a tweet that's been done after and one phone call most likely is really, really premature around a very, very significant move like this. And I think back to the point about institutionalization. The institutional players on the FTX cap table, I mean, they basically woke up, got to their office, and saw that their minority investment had been sold on Twitter to another player that was heavily involved in some of the factors that led to some of the liquidity crunch. And that's really hard to go to an investment committee. That's really hard to say, hey, we could have seen this coming. It's a massive tail risk that traditional investors don't quite know how to manage and don't quite know how to put in models.
So yesterday we spoke with Nick Carter with Castle Island Ventures, who argued that now the trust is gone given the liquidity crisis that FTX apparently couldn't handle. He says this is another example that crypto exchanges cannot be trusted unless they do proof of reserves. And Zhao actually tweeted last night as well that now Binance is planning to do proof of reserves soon. Do you think this will instill trust from the crypto community, or do you think more needs to be done?
We've built this whole structure of our V1 crypto industries around, hey, this is decentralized, this is transparent, therefore we don't need the same regulatory scrutiny around these traditional finance businesses. And unless we're living up to that and truly creating these decentralized, transparent, anybody can click all the way down to the ground floor type of structures, then we need to be regulating them exactly like traditional finance structures, and we may anyways. So I think something like this, where you're proving and you're actively demonstrating, okay, I have this blockchain wallet. This is mine. This is where all of the assets go. This is the map between client funds in and client funds out. Then you're not really living that sort of mantra of why we get to have an industry that's based on this trustless technology of blockchain. So I mean, the short answer is yes, it's a great step in the right direction. But I also think that we'll see a new type of business coming forward that places a much greater focus on things being in the user's name, ultimate transparency, leveraging these facets of blockchain to deliver services out to the end user, but without all of the challenges and commingling and opaqueness of our existing crypto businesses.
This mega deal is now drawing antitrust concern. According to a research report, the combined company would have a more than 80% share of the global crypto market. What do you think is next?
We're arguing about a pie that is this big in an industry that's the size of this country, and that's a great way to kill a nascent industry is by monopolizing it. The whole way that we got digital assets and crypto to where it is today is this spirit of radical cooperation and codifying and institutionalizing cooperation. So it's very anti-ethos to even have this level of concentration within an industry. And I do think this is a space where there's 100 ways that this deal can fall apart, and antitrust is probably number one about the largest and easiest. Again, it's something that regulators and traditional investors will understand as well. And again, something that is something that should have been looked at before you throw an announcement out on Twitter that, hey, this is happening. So yeah, I mean, I think it's a massive challenge, both for from a legal and regulatory perspective, but also from a future of the industry perspective.
Okay, before we go, we also want to give you an update on the U.S. midterm elections. The House and Senate are still up for grabs as ballots are still being counted nationwide. One winner in yesterday's election, though, crypto-friendly candidates. We told you about GMI PAC on Monday. That group funded 19 bipartisan House and Senate candidates in the general election. And as of this morning, 16 of those 19 candidates have won, including John Fetterman in Pennsylvania, Eric Schmidt in Missouri, and Brittany Peterson of Colorado. Of the 3 races yet to be called, all of GMI PAC's candidates currently hold a lead. All right, that's all for Crypto World today, but we'll be back again tomorrow, and we'll see you then.